You just bought your first home. Congratulations, you're now part of the American dream, right? You signed a 30-year mortgage, maybe you put down 5%, and you're paying about 7% interest. Your real estate agent told you this is how you build wealth. Your parents told you renting is throwing money away. Your banker smiled and said, "Don't worry, this is the safest investment you'll ever make." But here's the thing nobody tells you. You just signed a contract to pay the bank 2 to 3 times the purchase price of that house over 30 years. And if you refinance, move, or take out a home equity loan, which most people do, you'll effectively be paying for housing for 70 years. 70 years? That's not building wealth. That's you working a second job for the bank. I'm Tom, and this is The Money Syntax. I'm here to cut through the Wall Street jargon and give you the real talk on your money, even if it hurts your feelings a little bit. If you're someone who thinks your mortgage is your best investment and that paying off your house is how you get rich, hit subscribe and give this video a thumbs up. Because what I'm about to show you might change everything you think you know about your biggest asset. The 70-year trap. Look, I need to say this clearly. This is not financial advice. I am a guy on the internet tracking corporate mechanics, not your certified financial planner. Do your own math. Now, let's talk about the 70-year lie. The average American homeowner moves every 7 years. That means before you hit the 15-year mark on a 30-year mortgage, you've already sold and bought again 3 times. Every time you sell, you pay 6% in realtor commissions. Every time you buy, you pay closing costs and origination fees. And every new mortgage resets the amortization clock. So you're back to paying mostly interest all over again. Here's the math. On a $400,000 home with 7% interest and a 5% down payment, your total interest over 30 years is about $540,000. But if you refinance after 5 years to get a lower rate and then move after another 7, rolling your equity into a new mortgage, you stretch that interest burden across decades. Throw in a home equity line of credit, a renovation loan, or cashing out refinance, and the typical American family ends up paying the equivalent of a 70-year interest bill over their lifetime. The banking industry loves this. They call it the mortgage life cycle. You call it the American dream. What most people don't realize is that the average homeowner who follows the standard advice, buy a house, stay in it, pay down the mortgage, actually builds very little net worth compared to someone who rents and invests the difference. A study from the Federal Reserve showed that homeowners and renters with similar incomes had similar net worth growth when you account for maintenance costs, property taxes, and insurance. The only difference? The homeowner has a liability they can't walk away from easily. The wealthy don't buy homes the way you do. They don't sign 30-year loans with 7% interest. They use commercial financing, they buy with cash, or they structure deals where the property pays for itself through rental income. They treat housing as a cost to be minimized, not an investment to celebrate. But you're told to stretch your budget to the maximum, put down the minimum, and pray that appreciation bails you out. That's not a strategy. That's a gamble dressed up in patriotic language. The New Deal's dark side. Let's go back to where this all started. The 30-year mortgage, as we know, it didn't exist before the Great Depression. Before the 1930s, home loans were short-term 5 to 10 years with balloon payments. You'd pay interest only for the term, then owe the entire principal at once. Most people couldn't afford that, so homeownership was reserved for the wealthy. Enter Franklin Roosevelt's New Deal. In 1934, the Federal Housing Administration was created to stabilize the housing market. The FHA introduced the long-term, fully amortizing mortgage. It was revolutionary. Suddenly, a family could borrow for 30 years, pay a little each month, and own the home free and clear at the end. This was a step forward for economic security. FDR talked about freedom from want. Housing was part of that vision. But here's the hidden cost. The system was designed to benefit banks first. The FHA insured the loans, so banks took zero risk. They could lend at high rates with government backing. And the longer the loan term, the more interest they collected. A 30-year loan at 6% generates almost as much interest as principal over its life. The bank makes more from the loan than from the asset. Over time, the system evolved. Private mortgage insurance, Fannie Mae and Freddie Mac, the secondary mortgage market, all of these innovations made it easier for banks to offload risk and keep lending. They also made it easier for people to borrow more than they could afford. By the 1950s, the 30-year mortgage was standard. By the 2000s, we saw 40-year loans, interest-only products, and subprime mortgages that all but guaranteed default. The message from Wall Street was always the same: buy now, worry later. Homeownership became a proxy for financial responsibility. If you rented, you were throwing money away. If you bought, you were building equity. But the math never supported that narrative for most people. The real winner was the financial services industry: banks, mortgage brokers, real estate agents, title companies, appraisers, everyone who takes a slice of every transaction. And they designed a system where you are encouraged to transact as often as possible. Move, refinance, renovate, repeat, each time they take their cut. Each time your loan resets. Each time you move further from true ownership. The amortization scam. Now let's get into the mechanics, because this is where the real extraction happens. Most people have no idea how an amortization schedule works. In the first year of a 30-year mortgage at 7%, roughly 70% of your monthly payment goes to interest. On a $400,000 loan, that's about $2,300 in interest, and only about $300 toward principal in the first month. After 5 years of payments, you've paid the bank roughly $138,000 in total. How much equity have you built? About $24,000. The bank took over $100,000 of your money, and you got $24,000 of equity in return. That's a 5-to-1 ratio in the bank's favor. Now here's where the 70-year lie takes shape. When you refinance after 5 years, you reset that amortization schedule. Suddenly, you're back to paying 70% interest again, but you've also added new closing costs, origination fees, and appraisal charges, typically 3 to 6% of the loan amount. On a $400,000 home, that's $12,000 to $24,000 in fees just to refinance. If you move every 7 years and take out a new mortgage each time, you pay those transaction costs repeatedly. Over a 45-year working life, you might buy or refinance 6 to 8 times. The total transaction costs alone can exceed $100,000. And the interest you pay over that period, it can easily surpass $1 million. Here's what's worse. The banking industry knows this. They rely on churn. They profit from your fear of missing out on a lower rate. They profit from your desire to upgrade to a bigger house. They profit from your need to access equity for emergencies. Every time you transact, they win. The system is designed to keep you in debt forever. Consider the psychology. When rates drop, you feel like you're losing money if you don't refinance. When rates rise, you feel trapped because you can't afford to move. The bank has you either way. The only way to break the cycle is to understand that your primary residence is a consumption asset, not an investment. It provides shelter, but it doesn't generate cash flow. And when you finance it over 30 or more years, you're consuming far more in interest than you'll ever recoup in appreciation. This is the hidden extraction mechanism. The longer the loan term, the more you pay, and the more the bank extracts. How the rich buy homes. So how do the wealthy approach housing? They treat it as a cost center, not a wealth builder. They minimize the cost of shelter and deploy their capital into income-producing assets. Here's the framework. The wealthy avoid long-term consumer debt on non-productive assets. A primary residence is non-productive. It doesn't generate income. Financing a non-productive asset with a 30-year loan is one of the worst financial moves you can make. Instead, the wealthy use a few key strategies. First, they buy with cash when possible. If you can pay cash for a home, you eliminate the interest costs entirely. That $400,000 home now costs $400,000, not $800,000. Second, when they do use leverage, they use it on income-producing real estate. A rental property that generates monthly cash flow can justify a mortgage because the tenants pay the interest. The property pays for itself. The owner builds equity with other people's money. Third, they use commercial financing structures. Commercial real estate loans often have shorter terms and interest-only periods, but they're structured around the property's cash flow, not the borrower's personal income. This allows the wealthy to scale without personal liability. Fourth, they utilize the 1031 exchange, a provision in the tax code that allows investors to defer capital gains taxes when selling an investment property and reinvesting the proceeds into a like-kind property. This lets them compound equity tax-free indefinitely. Fifth, they treat their primary residence as a cost to be minimized. Many wealthy individuals rent in high-cost cities because the math favors renting versus buying. In Manhattan or San Francisco, renting a luxury apartment can be cheaper than the mortgage interest, property taxes, and maintenance on a comparable owned unit. The difference is invested in the stock market or private equity. Now, does this mean everyone should rent? Absolutely not. But it does mean you should run the numbers honestly. The New York Times has a rent versus buy calculator that accounts for transaction costs, maintenance, and investment returns. Plug in your local market. You might be surprised. The strategy that the wealthy use is simple. Minimize shelter costs, maximize productive investments. Your primary home should not be your largest investment. It should be your most efficient shelter. The 70-year loan system is designed to fool you into thinking otherwise. Breaking the 70-year cycle. Here is the analytical framework for breaking out of the 70-year mortgage trap. It involves understanding that the goal is to pay off your primary residence as quickly as possible, or to structure your housing so that someone else pays for it. Let's walk through the options without telling you what to do. Option 1 is the accelerated payoff approach. This strategy focuses on reducing the loan term to minimize total interest. By making one extra payment per year on a 30-year mortgage, you can cut the term to about 23 years and save tens of thousands in interest. By making a half payment every 2 weeks, a bi-weekly payment schedule, you effectively make 13 full payments per year instead of 12, which also shortens the term. Option 2 is the 15-year mortgage. Historically, 15-year mortgages carry lower interest rates than 30-year mortgages, sometimes by 0.5% or more. The monthly payment is higher, but the total interest paid is dramatically lower. On a $400,000 loan at 6%, a 30-year term costs about $463,000 in interest. A 15-year term at 5.5% costs about $188,000 in interest. That's a savings of $275,000. Option 3 is the house hacking strategy. This involves purchasing a multi-unit property, living in one unit, and renting out the others. The rental income covers the mortgage, taxes, and insurance. The owner lives for free while building equity with tenant money. Over time, the owner can repeat this process, acquiring more properties and eventually moving into a single-family home with no mortgage. Option 4 is the rental arbitrage strategy. In markets where the price-to-rent ratio is high, it can be mathematically superior to rent a primary residence and invest the difference between renting and buying. For example, if buying a $300,000 home costs $2,000 per month in mortgage, taxes, and insurance, but renting a similar home costs $1,500 per month, the $500 monthly difference invested in a diversified index fund over 30 years can grow to over $500,000 at a 7% annual return. Option 5 involves reducing the cost basis of your home before you buy. This means looking for undervalued properties, fixer-uppers, or homes in up-and-coming neighborhoods. A lower purchase price means less debt and less interest. The analysis shows that the path to financial independence often involves minimizing the cost of housing rather than maximizing the size of your mortgage. Wealthy understand that every dollar spent on mortgage interest is a dollar that could be compounding in your favor. Your housing wake-up call? Now here's where it gets personal. I want you to do something right now. Pull out your phone or open your laptop and look at your mortgage statement. Look at the amortization table. See exactly how much of your last payment went to interest versus principal. I guarantee the number will shock you. If you're in the first 5 years of a 30-year loan, you are paying the bank roughly 70 to 80% of your payment in pure profit for them. Ask yourself, is that how you want to spend the next 3 decades of your working life? This isn't about blaming real estate agents or bankers. They're playing the game they were trained to play. This is about you taking control of your own financial future. The system is not designed to make you wealthy. It is designed to make the banking system wealthy. Your job is to understand the rules so well that you can play a different game. Here's the question you need to answer honestly. Are you building equity, or are you building the bank's retirement? If you're paying mostly interest, refinancing every few years, and rolling costs into new loans, you are effectively renting from the bank. The only difference between you and a renter is that you're responsible for the roof and the water heater. Drop a comment below. Tell me your story. Have you ever run the numbers on your mortgage? Did you know how much interest you were paying? Were you surprised when you saw the totals? Share this video with someone you know who is about to buy their first home. They need to see the full picture before they sign. Because once you sign that 30-year mortgage, the clock starts. And if you're not careful, you'll be paying for that house for 70 years. Here's my final thought. Housing is a human right. Shelter is a necessity. But the way we finance housing in this country turns a necessity into a wealth extraction machine. The wealthy don't get rich by paying interest. They get rich by receiving it. The goal is not to own a bigger house. The goal is to own your time. And you cannot own your time if you're working 30 extra years to pay the bank's interest. Go look at your balance sheet with fresh eyes. Your future self will thank you.
Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.